What if I told you that right now, at this very moment, three massive forces are quietly colliding behind the scenes, and almost nobody is talking about how dangerous this combination really is? I'm talking about war tensions rising across the globe, inflation that refuses to die, and an AI boom that's starting to look eerily similar to past market bubbles. Separately, each one is powerful, but together, this could be the perfect financial storm. Now I know that sounds dramatic, but stay with me, because once you see how these pieces connect, you'll start looking at the economy very differently. Let's start with war. Historically, whenever geopolitical tensions rise, markets get nervous, and for good reason. Wars disrupt supply chains, increase government spending, and create uncertainty that investors hate. Think about energy prices for a second. When conflict hits key regions that produce oil or gas, supply gets tight, prices spike, and suddenly everything, from transportation to food, becomes more expensive. That's not just a headline. That hits your wallet directly. But here's where it gets more interesting. Governments don't just sit back during times of conflict. They spend a lot. Military budgets expand, emergency funds get deployed, and often this spending is financed through borrowing. And when governments borrow heavily, it can put pressure on currencies and inflation. So war doesn't just affect the battlefield, it echoes through the entire financial system. Now let's layer inflation on top of that. You've already felt it. Groceries cost more, fuel costs more, rent keeps climbing. Even though central banks around the world have been aggressively raising interest rates to cool things down, inflation is proving to be sticky. It's not going away as quickly as many expected. And here's the problem. High inflation changes behavior. Consumers spend differently. Businesses adjust pricing strategies. Investors become more cautious. But most importantly, central banks get stuck in a tough position. If they keep interest rates high to fight inflation, they risk slowing the economy too much. But if they cut rates too soon, inflation could come roaring back even stronger. It's like walking a tightrope. And right now, nobody's entirely sure which way things will tip. Now, here comes the third piece, and this is where things start to feel very familiar. Artificial intelligence? You've seen the hype. AI is everywhere. It's transforming industries, driving massive investments, and pushing stock markets higher, especially in tech sectors. Companies are promising a future powered by AI, smarter systems, faster productivity, and entirely new business models. And don't get me wrong, AI is real. It's powerful. It's transformative. But here's the question nobody wants to ask. Are we overestimating how quickly it will pay off? Because when you look at history, we've seen this pattern before. The dot-com bubble in the late 1990s, the housing market before 2008. A new technology or trend emerges. Excitement builds, money floods in, valuations skyrocket, and then reality eventually catches up. Right now, some AI-related companies are being valued based on future expectations that are incredibly optimistic. Investors are pricing in growth that hasn't happened yet. And when expectations get too far ahead of reality, that's when bubbles start forming. So now think about this. What happens when you combine all three? You've got geopolitical tensions pushing up costs and uncertainty. You've got inflation that's still lingering, forcing central banks into difficult decisions. And on top of that, you've got a potentially overheated AI market, driving stock prices higher than fundamentals might justify. This is where things get dangerous, because financial systems don't break from one factor alone. They break when multiple pressures hit at the same time. It's like a structural weakness. One crack might not collapse the system, but three cracks in the right places? That's when things start to fall apart. Imagine this scenario. Inflation stays higher than expected, so central banks keep interest rates elevated. At the same time, global tensions escalate, pushing energy prices even higher. Consumers start pulling back on spending. Companies begin missing earnings expectations. And suddenly, those high-flying AI stocks, priced for perfection, start disappointing investors. What happens next? Selling begins. At first, it's controlled. Then it accelerates. Confidence drops. And before you know it, what looked like a strong market starts unraveling quickly. Now, I'm not saying this is guaranteed to happen, but the risk is real. And it's something smart investors are paying attention to. Because here's the truth. Markets are driven by psychology, as much as they are by numbers. When people feel confident, they take risks. When they feel uncertain, they pull back. And right now, we're in a strange place where confidence and risk are both extremely high at the same time. That's not a stable combination. So what should you actually take away from all this? First, understand that we are in a complex environment. This is not a simple bull market where everything just goes up. There are powerful forces working in opposite directions, and that creates volatility. Second, be cautious of hype, especially when it comes to emerging technologies like AI. Just because something is revolutionary doesn't mean every investment tied to it is a good one. In fact, the biggest risks often hide where excitement is the highest. And third, pay attention to the bigger picture. Don't just look at stock prices. Look at what's happening globally. Inflation trends, interest rates, geopolitical developments. These are the signals that often come before major shifts in the market. Because by the time everyone realizes what's happening, it's usually too late. And that's really the core message here. The perfect financial storm doesn't announce itself. It builds quietly, layer by layer, until suddenly, it's impossible to ignore. War adds pressure, inflation tightens the system, and speculative bubbles create fragility. Put them together, and you get an environment where small shocks can have massive consequences. But here's the good news. Awareness is power. If you understand these dynamics, you're already ahead of most people. You're not just reacting to headlines. You're thinking critically about what's driving them. So the next time you hear about rising tensions, inflation updates, or the latest AI breakthrough, don't just see them as separate stories. Connect the dots. Because in today's world, everything is connected, and the biggest opportunities and risks come from understanding how those connections play out. And trust me, the next chapter of the global economy is going to be anything but boring.